the bullwhip supply chain effect, inflation surge, Fed fastest hikes, Trump tariffs, and then, of course, U.S. bombing Iran.
6 of them, yeah, okay.
Yeah, all of them should have wiped out earnings, but the S&P earnings have grown, and yet the equal weight PE is now 16 times. So the market's gotten cheaper in the last 6 years.
Tom Lee begins by revisiting the dramatic market swings we saw after Tariff Armageddon earlier this year. When trade tensions flared and tariffs escalated, markets went into a sharp sell-off. Investors feared that a recession was inevitable, and as panic spread, liquidation followed. But then something surprising happened. Instead of dragging into a prolonged slump or a flat, grinding bear market, equities staged a V-shaped recovery. This caught many investors off guard. A lot of people had exited, expecting a chance to re-enter at lower prices, but instead, the market rebounded so quickly that they were left underexposed.
I think many people, when April happened and we had Tariff Armageddon and the market went into a free fall, investors liquidated because they thought we were entering a recession. But, and as you guys had covered, like the market then staged a V-shaped recovery, which caught many people off guard because they wanted to have a chance to get in. They wanted the stock market to be like a K-shaped or flat line. Instead, it was a V-shaped bounce. And so most investors are underexposed at the moment, and they're trying to look at headlines with a half-empty view. But as you guys know, earnings have actually been really resilient, and I think it tells a very good story.
Yeah, Dow's hasn't been hitting. It has hit a new high, but it hasn't in the recent session. But S&P and NASDAQ continue to do pretty well. So there is also a perception, Tom, that valuations have returned to levels that have people worried, and you are citing an equity-weighted S&P multiple. Explain that. Of what? What's the equity-weighted multiple right now?
Yeah, what we're saying is instead of someone saying, oh, the MAG is making the market expensive, let's just take the average PE of the S&P of every stock, and it was around 17.6 times in 2019. Now we've had 6 what I call extinction-like events, COVID, the bullwhip supply chain effect, inflation surge, Fed fastest hikes, Trump tariffs, and then, of course, U.S. bombing Iran.
6 of them, yeah, okay.
Yeah, all of them should have wiped out earnings, but the S&P earnings have grown, and yet the equal weight PE is now 16 times. So the market's gotten cheaper in the last 6 years, despite proving they can grow earnings through 6 extinction-level events.
Think about it. When an analyst recommends a stock, they don't focus on what happened last quarter. They look at future discounted cash flows. They try to anticipate the value of the company 3, 5, or 10 years down the road. Visser argues the Fed should think the same way. If inflation is running hot today but deflationary forces are building in the future, particularly from AI, then reacting too aggressively right now risks damaging the economy unnecessarily.
We had a period of high growth and low inflation, and that was because of a productivity boom. But it was really about being forward thinking. And I think the comment about academic, which was reinforced in multiple interviews with David Zervos, David Malpass, other people that were at one point or still are in the final 11 for the Fed chair, they basically went through and said the Fed only focused on the most recent data points. If for the next 3 months we have CPI that comes in at 0.4, 0.4, 0.4, but we're heading into a period of deflationary situations with AI. When an analyst invests in a stock or they make a call on a stock, it's about the future discounted cash flows. It's not about what happened in the most recent quarter. It's not about what's going to happen in the next quarter. It's really about, in the Fed's, in Besant's mind, about what's coming down the road. And right now we have a situation where the labor market has been weakening. Most measures have, we've talked about it on here. They're not at recession levels. They're not at some warning level, but you can clearly see that AI is having an impact on the jobs market. They have a dual mandate. They have to pay attention to both inflation and also the jobs market. It's just very difficult to see the jobs market getting better as the AI acceleration continues. And that was the point of the paper, is whether or not you agree with this, the Fed is going to be run more like what Donald Trump wants once he gets his people in charge. And so the point of the paper was we're at a very important crossroads that to me reminds me of 2007, 2008, where fiscal policy, the AI action plan, the AI arms race, all of the things that the administration has talked about, the spending that's going to happen, is now going to be combined with monetary policy, which they want to run hot. They believe they want to make a bet that inflation is going to come down in the future. And if it means having CPI above 3% for the next 2 years, so be it, as long as they can work out of this. They also have a deficit problem. But just like in 2007, 2008, when we had a shift in both fiscal and monetary policy, you also had an innovation boom, which came from the software side and the smartphones. This time it's AI. Those three forces, to me, are very critical in kind of the next phase of what's happening in the United States. And so I think monetary policy should be aligned with the desires of the government from a fiscal side, as long as inflation's not out of control. And that's where we are right now.
AI's impact has been concentrated in software, automation of code, text, image generation, and analytics. But as we move into robotics and digital employees, the effects will be felt everywhere: manufacturing, logistics, healthcare, retail, and beyond. This isn't just a productivity boom, it's a fundamental rewriting of economic structures. Deflationary pressure will mount as costs drop and supply expands in industry after industry.
No one in the United States for a second would argue with the fact that there has been significant education inflation, significant healthcare inflation, significant auto insurance inflation, significant health insurance inflation. Housing affordability is off the chart, is at levels where most people can't afford a house. Those are the issues that came out of COVID. We had rapid acceleration in most of those, and I think those affect all Americans, regardless of where you stand in how much money you're making. And that's been the issue, and I think that's why the sentiment numbers are so low. Then when you start adding in the pressures that are coming from AI, this is where I do understand the concept of somehow or another this has to change. The administration wants rates to be lower because in their mind it will help the housing market. There's no guarantee it'll help the housing market because there's no guarantee that long-term rates, which are not controlled by short-term rates, will actually go down. And that's the fear that most people have, is that we're going to reignite inflation, we're going to have to turn around, raise rates, go through this. But I do believe, again, when you think about inflation, you have to think about what's happening from the AI situation. AI is going to be coming down the road. It will have deflationary implications for everything. And whether it takes 2 years or 3 years, we're only 4 or 5 years away from AGI, and the compounding of just AI acceleration is mind-boggling. And I know most people don't see it at this point because they don't see the benefits, because it's really been predominantly on the software side. But once we move into the embodiment side and we move into the robotics side, you're going to start to see massive deflationary pushes, because it's going to involve what we talked about last week as well, which is digital employees, artificial intelligence employees. Everything's going to change, and you'll start to see pricing power come down and competition come down. But for right now, everyone still feels the inflationary pressures. I don't care who they are. The humanoids and anything in the physical side are going to be the most obvious in terms of bringing prices down. The cost of a house will go down if humanoid workers can build the house. Why? Because they're cheaper than humans to build the house, but also they can work 24 hours a day. It's just a different mentality in terms they're trying to get these costs down to levels to where there's really no argument. You can basically build round the clock. You can do this without having to deal with the other expenses that come in, without the food, without the health insurance, without all these other components. So at some point we'll get there. The things you're mentioning, and I just want to make sure, the humanoid side, we're still talking 2030 before we actually get to the point where these things will start being rolled out, partly because of the scaling issues in terms of getting this up, but also those things you're mentioning, a lot of them are they're trained to do that thing. It's a lot harder to get them to learn how to do something new. And that's the part to where, we're getting closer to now. That's why, I'm starting to spend, as more time on robo-taxis, because I'm getting more interested in it. And there's an element of this, which is when you reach a point where they begin to learn on their own, meaning we're collecting data on the physical world. And this is why whenever, people hear this thing about, oh, it's AI, it's a bubble, we've reached the point, there's no more scaling. We have an infinite amount of data to learn every single day from the physical world in terms of how to move around in it, how to learn something new, how to create something new. So the humanoids are going to help dramatically when we get to that point. But before we get to the humanoids, we will have the digital employees through AI agents that are going to help the most in terms of bringing costs down on everything that you do. We're getting closer and closer to that. The first place it's going to help, as I've talked about, is in the profit margin side.
The challenge for policymakers and for investors is surviving the transition. Betting too hard on today's inflation could cause policymakers to miss the bigger picture. But betting too hard on AI's future could leave us exposed if deflation doesn't arrive as quickly as expected. As Visser emphasizes, this is not just about economics. It's about politics, technology, and society itself. And the decisions made in the next few years could define the path of the U.S. economy for decades to come.